Italy owns one of the largest gold reserves in the world, worth roughly $300 billion, and a single line in its 2026 draft budget has sparked serious international attention. The line states that the gold reserves managed and held by the Bank of Italy belong to the state in the name of the Italian people. On the surface, this sounds symbolic and patriotic. However, critics immediately began asking whether this wording signals a deeper intention. Could Italy be preparing to use, leverage, or even sell part of its massive gold stockpile to deal with its growing debt problem? To understand why this question matters, we first need to understand how Italy accumulated such a vast reserve in the first place. Italy currently holds about 2,450 tons of gold, making it the third largest holder globally after the United States and Germany. This surprises many observers because Italy has struggled with slow growth and high debt for decades. The story begins at the end of World War II, when Italy's gold reserves had been nearly wiped out. During the war, Nazi Germany, supported by Italy's fascist regime, seized around 120 tons of Italian gold, leaving the country with only about 20 tons by 1945. Italy was economically devastated and politically unstable. Then came American assistance through the Marshall Plan, which injected billions of dollars into Western Europe to rebuild shattered economies. In the decades that followed, Italy experienced what many call an economic miracle. From the 1950s through the early 1970s, the Italian economy grew at more than 5% annually. The country became an export-driven powerhouse, selling cars such as the Fiat 500, luxury fashion, machinery, and consumer goods across global markets. As dollars flowed into Italy from exports and US financial aid, the government converted much of those dollar reserves into gold. At the time, gold was viewed as a symbol of financial strength and discipline. It helped build confidence in Italy's currency, provided protection against future crises, and signaled stability to international investors. By 1960, Italy's gold holdings had climbed to around 1,400 tons, including much of the gold that had been recovered after the war. Over the following decades, the reserves remained largely untouched. However, the economic story changed in the 1980s. Growth slowed, productivity weakened, and governments began borrowing heavily to sustain spending. Italy's national debt rose sharply, climbing from about 59% of GDP in 1980 to well over 100% by the mid-1990s. Today, Italy's public debt exceeds €3 trillion and is projected to reach around 137% of GDP. That makes it one of the most indebted developed economies in the world. Naturally, some political voices began suggesting that selling part of Italy's gold reserves could help reduce debt or ease fiscal pressure. With gold prices recently hitting record highs, briefly approaching $5,141 per ounce, the idea may seem tempting. But the reality is more complicated. Even at an estimated value of €300 billion, Italy's gold would cover less than 10% of its total outstanding debt. Selling all of it would not solve the structural debt problem. More importantly, Italy cannot freely use its gold to finance government spending. The Bank of Italy manages the reserves and operates independently within the European system of central banks. Under European Union rules, central banks are prohibited from directly financing public deficits. This means Italy cannot simply transfer gold to the state budget or liquidate it to fund tax cuts or subsidies without approval from the European Central Bank, which is highly unlikely to grant such permission. Historically, while countries like the United Kingdom and France sold portions of their gold reserves during financial crises, Italy consistently refused to do so. The Bank of Italy considers gold a strategic national asset and a long-term safety buffer for an economy that has experienced repeated cycles of instability. Gold also represents financial credibility in international markets. So why has the debate resurfaced now? The controversy centers on that symbolic amendment in the 2026 draft budget, declaring that the gold belongs to the Italian people through the state. Prime Minister Giorgia Meloni and her coalition insist that nothing radical is planned and that the measure simply reinforces national ownership. However, opposition parties worry that ahead of future elections, political pressure could build to use the reserves in some way to finance popular policies. Even if legally constrained, the symbolism alone has raised eyebrows across Europe. The European Central Bank has reportedly expressed concern. emphasizing that central bank independence must remain intact. This debate is unfolding at a time when global interest in gold is rising. Central banks around the world have been increasing their gold purchases amid geopolitical tensions, rising debt levels, and concerns about over-reliance on the US dollar. Gold is once again seen as a safe haven asset and a hedge against uncertainty. In that context, any hint that the world's third largest holder might alter its gold policy draws global attention. However, most legal experts agree that this amendment does not actually change who controls the gold or how it can be used. Italy is still bound by European treaties, and the Bank of Italy remains part of the European central banking system. That means the government cannot simply sell the gold or use it to finance public spending without wider European approval. But politically, the debate is powerful, because this discussion is not really about moving gold bars. It's about sovereignty, financial responsibility, and public trust. It reflects a broader tension seen across many democracies today. How should countries balance national decision-making with international agreements? How should governments manage high public debt while maintaining financial stability? These are legitimate policy questions, and reasonable people can disagree on the answers. Italy's gold represents decades of history, from post-war recovery to economic growth and financial challenges. For many, it symbolizes security and long-term stability. For others, it raises questions about whether national assets should ever be used during difficult economic periods. So here's a constructive question for you. Do you believe strategic national reserves like gold should always remain untouched, or should they be considered in extreme financial situations? Share your perspective respectfully in the comments. I'm genuinely interested in seeing the range of opinions. Shout out to David Ray for being the top comment on our last video. If you want to be featured next, drop a strong comment below and click the video on your screen right now. You're going to love it.